Let's talk private credit. A lot of talk around that at the moment and the possibilities and opportunities it presents. Is it an all-weather strategy though? Let's get into that. Frank Donnelly joining us from MA Financial. Frank, good to see you.
Good to see you, Andrew.
Is it an all-weather strategy?
Well, I think, to I guess, quote Mark Twain, the reports of the death of private credit have actually been greatly exaggerated. There was a lot of talk about that during the period in which we went from low interest rates into a higher for longer interest rate environment. And there were a lot of suggestions that where the private credit loans were being made were going to be either risky or non-resilient parts of the economy. I think that actually hasn't proven to be the case. And in my view, private lending has represented quite a secular evolution of the overall credit markets. And what we're really seeing in that asset class is very consistent, resilient performance. It's really been the asset class, I think, of certainly 2022 and 2023. And I think the outlook still in 24 is very, very robust.
Well, why? What are you seeing with that outlook that gives you that confidence that it will continue into 2024?
Well, if you think about what's happening in private credit, at the moment, this is a floating rate asset class. So you're focused on the spread that you're earning above base rates and where they are today. That's at the moment delivering a return to investors of between about 8 and 12%, depending on exactly how you're playing that strategy. Now, if you think returns between 8 to 12% when you're in a secured, a senior position, you have strong asset collateral, you're lending to companies with robust fundamentals and strong business models, that's actually a very compelling return. If you think about that compared to, for example, the long run return on equities, which is around 9 to 9.5%, or what is available at the moment in the bond universe, it's pretty compelling to be in that position, in the driver's seat, more senior in the capital structure, the primary creditor and therefore really owner of the assets that you're lending to, and you're earning these kind of returns consistently.
However, there's a prospect that rates will be cut this year, not just in the States, but also here, perhaps late, but most accept that is going to be the case. What then would that effect be?
Yeah, look, we do think that will be the case too. And if rates do get cut, what's going to be the driver of that? Well, I think the driver will have to be some consistently soft data, perhaps in things like retail sales, business confidence, and certainly in the labour market, in order for central banks to actually cut rates from where they are here. Now, if that's the case, and there is some softness that's leading to some more, I guess, stimulatory activity in the economy, then you really need to be thinking about fundamentals. And the good thing about private lending is that it isn't an asset class that's driven by sentiment and momentum. We're not trading here. What we're actually doing is saying, I'm going to go and find a borrower, a company, or a type of asset that I want to lend to, that I can lend to and believe that the prospects of me getting my income, my interest along the way, and them ultimately repaying me is very high. So because it's so fundamentally oriented in an environment where rates might come down, that's where you want to be. Now, I said we're floating rates, so sure, if base rates do get cut, then because it's a floating rate assets, the returns might come down a little bit, but the spread, the premium you're earning over and above the benchmark rates are still actually very compelling, and I think you'll see that performance continue across the board. There will, of course, be pockets of risk, and there will always be things to avoid. You do need to be very careful when you're making a loan, that you're doing it in a selective manner, and that you're focused on things like downside protection and the terms and covenants that will protect you. But the thing about being a private lender as well is that you are in the driver's seat. So if things do go wrong, you have maximum control to actually protect your position, which is a nice place to be if we are in the environment that you're talking about.
So you're presenting that opportunity there of certainly what you can earn in private credit compared with equities, for instance. How then, as a retail investor, do you get access to that?
Yeah, well, the good thing about this asset class is that it has been democratized. If you go back only 5 or 10 years, this was the domain of large institutional investors or actually banks. What's really happened here with private credit is that there was lending that was done in the banking system, and because of some secular, structural, or regulatory changes, that's fallen away from banks. And so now it's been democratized, originally to large institutional investors, but there are now a range of ways for retail investors to access these strategies, both in unlisted funds that they can invest so often as low as $10,000 or even $5,000 in some cases on an ongoing basis, and earn that kind of income. And there are even, for some types of exposures, listed ways to get exposure to this asset class, which is pretty compelling.
What sort of narrative are you expecting from the RBA today?
Look, our view is that markets across the board globally have been expecting interest rate cuts too soon. We expect later this year that there will be maybe 1 or 2 interest rate cuts, but we are more data oriented. We need to see the data first. I think certainly the RBA will be influenced by the comments made by Jerome Powell, the Fed Reserve Chair, over the weekend about this must be a data-led approach before we're going to see central banks cut rates. And I think that the RBA will follow that and really want to see what happens as the higher interest rates that persist today flow through the economy for a little bit more before we'll get some reprieve, unfortunately.